So sometimes markets celebrate bad news as good news, and then other times it celebrates good news as good news. But right now in time, it's celebrating the Federal Reserve because with just 1/4 point rate cut, investors are now betting recession risks are suddenly a lot lower from where they were, if not gone forever, and this economy is going to soft land. So if you've been living under a rock, you haven't heard that yesterday the Federal Reserve cut rates for the first time in 2025, a 1/4 percentage point down to a range of 4% to 4.25%. They like a range, so they got some breathing room to wiggle around. Now, that 25 basis point cut, that sounds pretty small, like I agree. But the symbolism behind that is huge. It signals a shift from the members of the Fed. The Fed is no longer laser focused on fighting inflation. Instead, now it's prioritizing growth and jobs, that job market. And the pivot that we've seen came after months of weak data. We've been covering it. Stay tuned here on this channel because I'm always trying to stay up to date with what's going on. But it was the job growth that has slowed to a crawl. Unemployment has ticked up to 4.3%, and the broader economy has been looking fragile for quite a while. But rather than panic, markets rallied. And that's mainly because the Fed support means lower borrowing costs, easier credit, and a signal that policymakers will act to keep the slowdown from spiraling into something worse. Now, what we've seen is that the markets were pretty optimistic on this. The numbers tell the complete story. So since the first bad jobs report we got back in August, the S&P 500 is up 6%. But I got a kicker for you. Small cap stocks in the Russell 2000 are up 11%. And that's super important because smaller companies are more sensitive to economic ups and downs, all of the hiccups that come and go. And their strength, those smaller companies, suggests that investors are betting on an upswing in both consumers and businesses spending, which they see holding up resilient now that rates are moving in the lower direction. And today, it wasn't just small caps that celebrated. The NASDAQ closed at a 27th record high of this year, up 0.94%. The S&P 500 logged its 26th record, up 0.448%. And even the Dow joined in. So we've seen all three indices closing up in the green territory today at new records, and the Dow closed up 0.27% for its fifth record close of 2025. Now, on top of the Fed, there was another reason to celebrate. So tech had its own fireworks because NVIDIA announced a $5 billion investment into the company Intel, which has been struggling to stay relevant in the chip race. Now, Intel stock exploded more than 20% higher in one day today as NVIDIA, the world's most valuable company, gained about 3%. Now, the partnership is seen as symbolic because Intel gets this lifeline and NVIDIA gets to expand its production muscle. And Wall Street gets another reason to pile into AI and semiconductor plays. And tech momentum combined with the Fed's pivot lit a fire under markets this week. Now, over history, of course, not every rate cutting cycle ends in this celebration we're seeing. Historically, markets have struggled during cuts tied to recessions like early 1980s, 2001, 2007. Those are some of the examples. And in those cases, stocks fell as the economy sank, which makes sense. But this time, and you remember the most dangerous words in investing, this time is different. This time, optimism is different. Analysts point to stable interest rates, cooling inflation, fiscal stimulus, massive AI investment, productivity gains from AI, and the likelihood that further cuts are down the road as reasons that growth could hold up and stocks keep doing good. So in other words, if stocks keep rising, it'll be because the economy keeps moving in a good direction, not just because rates are moving lower. Now, that isn't absent risks. So it's not all smooth sailing. Risks are still there. They're still real. The labor market is softening. Tariff uncertainty could flare up again, assuming they're not deemed illegal. U.S. debt and deficits, gosh, that's a whole nother topic. It seems every year that one comes up. And that's pushing bond yields higher, putting pressure on companies and consumers because bond yields impact the interest rates that matter. Think like mortgages or some of your longer term borrowing costs, the loans that actually matter to the businesses and the companies. So then there's valuation for stocks. So as I pull stocks back up and you're looking at all these cool looking charts, valuations could be measured by this CAPE ratio, which is a metric developed by Noble Robert Schiller. The S&P 500 is at its most expensive level since that of the dot-com bubble. Then at the same time, margin debt level, that's another red flag, as borrowing to buy stocks has jumped 69% since 2022, nearing a $1.1 trillion record. And now that amplifies both gains, which is good, but imagine the losses that accrue in a downward spiral. Now, today we got some economic signals to look out for. So today we seen the leading economic index, and what that showed was a sharper slowdown than economists had expected or hoped for. It fell 0.5% in August, which was the steepest drop since April, hinting that overall activity is cooling, and the conference board isn't calling for some recession based off of this data, but it does see growth slowing to 1.6% next year from nearly 3% in 2024. Then we also got jobless claims today. So meanwhile, jobless claims told a completely mixed story because new filings dropped back to 231,000 last week after this suspicious spike we seen from the prior week before. So they really edged up high and they're like, oh shoot, this is the sign the job market's going to complete shambles. And then they drop back down. So it's like, false flag. Continuing claims are still steady at about 1.92 million. That's a record of its own, but I mean, it's been hanging around in that range for quite a while. But if you zoom out, the labor market picture's pretty clear. Hiring has slowed dramatically, with fewer than 30,000 jobs being added per month over the last quarter. That's down over 100,000 jobs earlier this year. Then unemployment remains pretty modest but has edged up higher, and it's the exact softness that has pushed the Fed to pivot in the first place and kind of change their mandate on their fight on inflation to maximum employment being more important. So here's where we stand, everybody. The Fed has cut, markets have rallied, AI continues to dominate headlines, but the balance is fragile. Valuations are stretched, the labor market is weakening, and debt loads are heavier than ever. The Fed shift lowers the odds of a recession, but it doesn't erase the risk. Whether stocks keep climbing depends on whether growth holds steady and consumers keep spending. So tomorrow's data and the months ahead will tell us whether this rally is built on a solid foundation or if it's setting up for a larger test. I'll be sure to keep on covering everything that happens as it comes out, everybody. Thank you for hanging out with me. Hope we're learning some valuable information together. I'll see you in the next one, y'all. Y'all have a good one.